Your voice is not audible, ma'am. You'll have to unmute. No.
Cannot hear her.
Hello.
Hello, I'm audible.
Yes.
Yes, Amrita, you can start.
Yes. Good evening, everyone, and a warm welcome to this insightful session on IPO from filling to listing. Today, we are privileged to have with us Mr. Karan Joshi, a seasoned technical and derivatives analyst with extensive experience in trading and system development across various asset classes, along with a deep understanding of global macroeconomics. We are delighted to have you with us, sir. Over to you, sir.
Thank you, Amrita, for that introduction. So, hello, friends. Good evening to all of you and a happy Diwali. Now, friends, I've been trading, investing in the market since my junior college days. So, I have around 20 years of trading experience, and I've been fully employed in the market from 2011 onwards. Okay, and in that duration, I have applied for a lot of IPOs, many of which I didn't get allotted, but that's not in our hands. So today we are going to share with you a small presentation about how do we select the stocks. Okay, so I would like to share my screen now. Yeah, just a second.
So you can share it usually, sir. Share your
Yeah,
screen and I will present it.
share. Now this should be, my screen should be visible to everyone. Is it clearly visible, friends? Is my screen visible, friends? Anandu,
Yes,
Kishore sir, anyone?
yes, sir. Yes, sir. Yes, sir. It's visible.
Great. Yep. So, friends, let us start with this. So, IPOs from filing to listing. Now, we'll try to cover as many points as we can. So, what is an IPO in simple terms? It's an initial public offering. We all know what the term IPO stands for, but it represents a pivotal moment for that private limited company, wherein it becomes public. This is the first time that shares of that stock, that company, are available for the masses to invest in. So this gives us, people like myself and you all, the first opportunity to become a part owner of a company that we believe in. Okay, this is very important, that we should have that belief that this company is going to do well, grow, prosper, along the years. So why do companies launch IPOs? Raise capital for growth. So there could be many reasons, okay friends. All of them might not be the best case scenarios from an investor's point of view. So that's what you have to understand, that out of these, which are the scenarios that suit you the best. So first case is raise capital for growth. So if a company comes up with an IPO and in its DHRP it states that they are raising funds for expansion, to set up a new factory, to open new branches, to spend on research on new products, or they are trying to penetrate a new market, a new geography. These are positive signs that whatever money we are going to invest in this company will be used for the growth of the company, for its business expansion. So that's, according to me, that's a good sign. Point number 2, reduce debt burden. So many companies do come up with IPOs to reduce their debt. So this ends up strengthening the balance sheet by paying off loans and improving the company's financial flexibility. Now this point needs to be scrutinized, friends. We need to go into the details, into the depth of the company's financials and see why is it, first of all, why does it have debt? Is it because of some wrong decisions made by the management in the past? Okay, or is it in its growth phase, that while a company is initially in its growth phase, it ends up borrowing a lot of money? As the companies mature, they tend to pay off their debts, and many of them actually end up becoming debt free as well. So we have to understand what stage is that company in. Is it in the growth stage, or is it a well established firm, or even better than that, is it a monopoly? Monopolies generally don't have any debts, they are supposed to be debt free. So we do have to do a lot of digging around and find out the reason behind that debt. If a company is just posting losses, then it's a very big red flag for us. We should just keep a safe distance from those kind of a company. Right. Point number 3, reward stakeholders. So the company is just getting listed to provide liquidity to early investors, founders, and employees who believed in the vision. So again, the reward stakeholders is an escape opportunity. It can be seen as an escape opportunity if your stock is not performing as per the investors' expectations. So many a times it happens that a bull market is going on, okay, and in the bull market everyone is jubilant. We are all going through euphoria, and we've thrown caution to the wind. Basically, we stop avoiding the checklist. We don't really verify if a company is good or bad. We are just going through the motions and we keep on applying all the IPOs. Okay, so this is where some of the companies may just pass their stock to us. So where we need to analyze the stock properly. That although it is dressed up as a reward for stakeholders, but are the stakeholders looking to exit Is it the reason why it's first of all getting listed, or is it getting listed for value unlocking? Okay, that's what we have to understand. There are companies which get listed just for value unlocking. They don't really need the fund, but by getting listed, they want to test the market. They want to see how much is the retail trader willing to pay to buy shares of my company. So point number 3, reward stakeholders, needs to be studied in depth. Then fourth reason could be a brand building credibility. Okay, build brand credibility. So listed companies, they get a lot of exposure, friends. There is enhanced visibility, prestige, and it gives you some credibility as well. So people will naturally start trusting the company more if it is listed on the exchanges, BSE and NSE. So I agree with this reason as well, that it helps build credibility. I mean, just to explain in simple terms, a private firm will struggle to use their company's shares as collateral when they are borrowing money. But a listed company can easily use their own shares. They can pledge their shares against a loan, against an asset backed loan. So that's an advantage for these companies. So these points that we've made over here are from the company's point of view. Why would a company get listed? As an investor, you have to read objects of the issue section to understand what lies in it for you, because that's where it will be simplified. If you try to just read the marketing part that the company is presenting to you, they are just going to highlight all the good features, the salient features about their own company. They are not going to highlight the negatives, the pitfalls for you. So by reading the objects of the issue, we can easily understand where is my money going. Is it going to pay off previous debt? Is it going for expansion? It will be clearly mentioned in the objects of the issue part. So moving forward, the IPO journey, friends. So understanding the complete process from board approval to stock exchange listing. A company, let's say a company decides to go public. First, it will take the board's approval. It will appoint merchant bankers and legal advisors. They will do the SEBI filing, the draft red herring prospectus. Okay, it is submitted for regulatory review. They get their approval, then a price band is fixed. Companies and bankers, they'll carry out the book building process, and based on that they'll determine the offer price range. Your next step is the IPO. It will open up for subscriptions. So before the IPO opens up for subscription, so between point number 3 and point number 4, friends, there will be a lot of marketing campaigns, advertising campaigns, road shows that will be conducted to spread awareness, or rather to highlight the particular company, its business, how many lives they have touched through their products. All these things will be highlighted in this phase between point number 3 and point number 4. So I have had the opportunity to attend several such roadshow events or analyst meets that they conduct. Okay, that's where we can directly ask the management questions. So do keep reading the newspapers, friends. There will be advertisements about upcoming IPOs and their meetings that happen. There are analyst meets that happen. So those are for people from the industry employed in the broking industry or mutual fund industry. And there can be public meets as well. That is termed as an investor meet. So even that you can track, and anyone can visit these events. Okay, so do keep reading about that. So once the IPO opens for subscription, investors can start applying through various channels. I mean, earlier we had to fill out big lengthy forms and we had to submit a check as well. But since 2008 January, we have shifted to the ASBA mode. Okay, application supported by blocked amount. So I remember it was post Reliance Power IPO that ASBA was introduced, and from there onwards, it's been the go through method. Nowadays, we can easily apply for and subscribe for an IPO from our cell phones as well. You can make payments through UPI as well. So it's become very, very convenient right now. And here I would like to point out, friends, that when you apply for IPOs, it doesn't matter how many accounts you have with brokers. If an individual is having 10 trading accounts with 10 different brokers, it does not mean that they can apply from all 10 accounts. The IPO subscription is accepted on PAN card basis. Okay, so your subscription will be accepted, one subscription per PAN card. So don't try to apply from different accounts of your own name. Yes, if you have accounts of other members of your family, then yes, try to apply from different PAN card numbers. That might increase your probability of getting some allocation, but avoid applying from multiple accounts of your own name. So application period now has come down to just 3 working days. Typically 3 working days for retail investors to participate. Once the IPO closes, the subscription window ends and the demand assessment begins. Then we move to allotment and refunds. This is where shares allocated via lottery, if oversubscribed, the shares are allocated via lottery. If it is oversubscribed, your refunds will be processed. So now the money does not leave your account, friends. That's the beauty of ASBA. Okay, application supported by block amount. That when you have made the application, that money is in your account. It is not leaving your account. It's just blocked for a particular purpose. If you win the allocation in the lottery, okay, in that case, money will be withdrawn from your account. Otherwise, the money doesn't leave your account. It will still be counted in your AQB. AQB is your average quarterly balance. Okay, so the refund process is this one. So if you don't get an allocation, that money is released. It's from the block. It has never really left your account. And then you have the listing on the exchanges, NSE and BSE. Trading begins, market determines the opening prices. So normally our market starts at 9 o'clock, the trading hours from 9 onwards. 9 to 9:15 is your pre-opening, and from 9:15 trading starts. But IPO on the first day when the company is getting listed, the first day the listing happens at 10 a.m. Okay, listing happens at 10 a.m. and then the trading begins with the opening bell, and based on the demand and supply equation, the price will either open with a premium or it will open flat. By flat I mean at whatever issue price was there, or if the supply is more than the demand, then it can also open at a discount. So there are three possibilities, friends. Some IPOs which which are actually done with the purpose of value unlocking, they tend to have bumper openings, that they just open with big premiums. Then there are some IPOs for whom the what do you say, the public demand was lukewarm. They might have a flat opening. Okay. So not just the public demand, the overall market sentiment at that point of time also plays a big role. So it is possible that a stock gets oversubscribed a lot. It gets oversubscribed a lot, but within 3-4 days, the overall environment of the market has turned bearish. For example, the company IPO starts on, let's say, Thursday or Wednesday. That Wednesday, Thursday, Friday, and from Tuesday onwards, the company will get listed Tuesday or Wednesday. But over the weekend, Mr. Trump ends up saying something very bad, very pessimistic for the Indian markets. Now, that will change the overall sentiment, the mass sentiment. So now, during listing, the company might not really enjoy the premium opening that we were initially expecting. Okay, so sentiments play a very big role. Fundamentally strong companies might have a poor opening, and many a times absolutely weak stocks, fundamentally weak stocks, might open with a bumper opening, 20% gap up, 30% gap up. All of that is possible. So what are the things that we should be looking on from a trader's point of view? Business model clarity. Okay. So I follow this rule, friends, that I am not going to apply to any IPO if I'm not sure about the company's business model. Okay, if it's a company whose name I'm not familiar with, or that sector itself is out of my depths, then I will not really go for that IPO. So I have an engineering background, so the auto sector I understand properly, right? Auto ancillaries, metals. I have a decent understanding of these sectors, but my knowledge about banking, finance, NBFCs, these gold loan companies, my knowledge about them is textbookish. Now I've been in the market for 2 decades, so I have read a lot of books, but still my knowledge on these sectors is bookish. So whenever a new IPO from those sectors comes up, I'm not really that confident because I don't have clarity about that business model. So unless you fully understand how the company is generating revenue, okay, don't really get overexcited and subscribe. You first need to understand the business model. If you are comfortable with it, if it makes sense to you, then go ahead. Because in a bull market, there will be a lot of IPOs coming. I mean, if you just search online, then the numbers for 2023 and 2024, in these 2 years, we had more than 500 IPOs. That's a huge number. In 2017, 2018, we used to have like 15 IPOs, 20 IPOs in a year. Whereas in 2023, 2024, we've had 250, 270 IPOs in a year. So that is a lot of new companies getting listed. I'm sure all of them are not fundamentally in sound health. So understanding the business will bring a lot of clarity. Then we have the financial performance as well. So this is basic research. We need to study the balance sheet, the profit and loss statement, revenue growth trend. Is it really on the growth part or not? Are the margins consistent? If the profit margins of a company are not consistent enough, then that tells me that this company does not have control either over its raw materials or the supply chain, the entire supply chain. So I like to see consistency in the margins as well. Okay, and yes, minimum I personally like to track 5 years performance. That at least for the past 5 years, I need to see consistency in the company's performance. Valuation analysis. So this is where we are asking ourselves, is the price reasonable? What are its peers? By peers, we mean its rivals or players from the same industry. How are they performing? If company which is already listed is having a certain price to earnings ratio, in comparison to that listed company, what is the new one, the IPO company, doing? Is it having a higher P ratio or a lower P ratio? Okay, then obviously we need to compare the size as well. We cannot really compare a large cap with a micro cap that is getting listed. So, for example, when Hyundai Motors came up with the IPO, you cannot compare it with smaller companies. Hyundai is India's second largest car seller. Okay, market share wise, it is second only to Maruti. Maruti is long way miles ahead of all other companies, but Hyundai is the number two, followed by Tata Motors and Mahindra and all those other companies. Okay, so we have to compare it with companies of a relatable size. You cannot compare a 20,000 crore market cap company with a company that has a 4 lakh, 5 lakh crore market cap. Okay, so be reasonable when you are comparing it with the peer group. This is where many of the analysts or many of the traders go wrong, that while comparing, they just justify their own decision rather than taking the decision after comparing. People just make up their minds first that I am going to buy this. Now I will just keep searching for positives about this company. Forget the neutral, unbiased comparison. First, I have formed my opinion. Now I'm going to do research in such a way that my buying decision is justified. So that's a wrong approach, friends. Maybe in a bull run, you might get lucky a couple of times. But once the market starts going sideways, once the liquidity starts squeezing out, then that sort of an approach will get you in trouble. Right? Then we move on to sector outlook. Basically, is the industry growing or saturated? What are the future growth drivers and competitive threats? We must understand them. Right now, the whole market, the whole retail space is shouting EV, 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 or renewable energy, green energy, green energy. But we have to understand that is that industry growing or is it saturated? I mean, green energy, is it a new field? Suzlon has been listed for 19 years now. Yeah, I've traded Suzlon in 2006 Diwali, from there onwards. So I don't feel that green energy is a new upcoming sector. It's been in the development stage for almost 3 decades now. So do read about the sector, friends. That is it a growing sector or is it saturated? What are the future growth drivers and competitive threats? And we need to read about the promoter's track record as well. What is their corporate performance history? Have they scaled up in their career, that they started from a company, that company grew, then they moved to an even bigger company and now they are heading a multinational? Or is that trajectory downwards, that from a bigger company they are going lower and lower to a smaller company? Is their image clean enough or is it scandalous? These things matter. Okay, in the long run, it also affects the company's ability to raise debt. If a person having a good track record of good performance record, that person can pull the right strings and can raise funds easily. Whereas a person with a notorious past will struggle to raise debt. Even if they do manage to raise debt, it will be at a higher rate. So do spare some time and read about the promoter's track record as well. And next, we have understanding the DRHP, the draft red herring prospectus. What it is? The DRHP is the comprehensive disclosure document filed with SEBI containing every material detail about the company, its finances, risks, and the offering itself. This is a publicly available document on SEBI's website and exchange platforms. In fact, now you can just search it online as well. Key sections that you want to review is financial summary, that will show you the revenue, profit trends, and the key metrics. Promoters shareholding, who owns and what potential dilution. Risk factors, everything that could go wrong. Obviously, this would be a diluted revelation that they do in the risk factors. So you will have to do your own diligence about the risk factors. Objects of the issue, yes. This brings a lot of clarity to us, basically how funds will be deployed. Because many times I've seen that in the financial summary or even in the promoters' notes to the shareholders, they tend to use a lot of corporate jargon, and deliver a softer blow. If something is really bad for the company, through smart wordplay, a promoter can just downplay that event, just give you a softer blow. So in the management discussion, financial summary, a lot of things can be, I would say, twisted. But by looking at the objects of the issue, you get a lot of clarity. If, for example, here we've given Tata Capital's draft hearing prospectus, clearly outlined that the funds would be used for business expansion, regulatory capital requirements, and general corporate purposes, providing transparency on capital deployment. Price bands and issue types. So the company, if it's a fixed price issue, the company sets one predetermined price for all investors, less common in modern IPOs, offering simplicity but less price discovery. So this kind of an IPO is a rarity, friends. Okay, I don't recollect the last IPO that I filled with a fixed price issue. What we follow in India mostly is your book built issue. So investors bid within a price band, example 500 to 520, and the final price is determined based on demand, allowing market forces to establish fair value. So normally people prefer to apply at the upper band. So if the company's IPO application price is between 500 to 520, that's the range. Generally people apply at the higher band, so they'll apply at 520. Okay, if the demand is high, then that issue is going to be built or finally approved at 520. Now cutoff price, the final price decided after evaluating all bids, is known as the cutoff price. Now retail investors can bid at cutoff price to accept whatever price is determined, maximizing allotment chances. So here's a tip for you, friends. Always bid at the cutoff price rather than the lower band. Either you bid at the upper band or you bid at the cutoff price. This signals strong demand and significantly will increase your chance of receiving an allotment, especially in oversubscribed issues. So here I would like to add a point, friends. Imagine that you applied for the IPO at the upper band, that is at 520. Okay, and the IPO, the company gets listed, its price turns out to be at 515. Okay, the issuing price turns out to be 515. So you will get that 5 rupee refund. It's not that you are applying at 520, so all your money is gone. No. If it is getting issued at the final issue price is decided as 515, then whoever has applied at a higher price will receive that refund, but at a retail level. Okay, at a retail level you will get that refund. So how IPOs are allotted. Now understanding this process helps set realistic expectations. So for non-institutionals, it is 15%. For high net worth individuals, retail investors get 35% allocation. QIBs, that is qualified institutional buyers, can get 50% reservations. So that will comprise of your mutual funds and insurance companies. And this is how the allocation happens. And the allocation is basically decided based on the lottery system. So once these are the quotas, that retail participation quota is maximum 35%. Okay, it's not always 35%. It is maximum 35%. So the lottery system is when the IPO is oversubscribed in any category, shares are allotted proportionally through a computerized lottery system ensuring fairness. So if an IPO is subscribed just one time, then you have 100% probability of getting allocation. If it is subscribed two times, you have a 50% probability of getting an allocation. So as the number of times it gets oversubscribed increases, your probability of getting that allocation keeps thinning out. So generally smart investors, they try to apply from more PAN cards. That you have 5 members in your family eligible for applying, you apply from all 5 names. So that's how you are increasing the odds of you getting an IPO. All right. So do read about these points, friends. Now, one thing I can say about the retail investors allocation, that 35 is the maximum, and companies which have posted continuous 3 years of profits, okay, continuous 3 years of profits, the years being the before the IPO, those years, only those companies can offer 35% to the retail investor. If a company has not posted continuous 3 years profit, then the retail allocation is limited to 10%. In that case, the QIB weightage quota can be increased to 75%. All right. So it's a good mechanism that we follow. That retail investors are more vulnerable, easy to trap investors. So if a company is not really profitable throughout, then they will have to keep the retail quota limited to 10%. This is something many participants are not aware of. I've had chats with people who apply every IPO under the sun but are still not aware of this part. That how is retail investor allocation quota decided? Okay, so do keep this in mind, friends. That when you read the draft red herring prospectus, if you see that the company's retail quota is 10%, it simply means it is not a throughout profit making company. It has either had one bad year or has been a loss making company. So that's a simple hint or a shortcut for you. It will save you a lot of time with your research. Okay, so reading subscription data is published daily during the IPO period on the exchange websites. You can even find this out online, or there are third-party apps like Money Control that will also share the same data with you. What to look out for: QIB subscription. High institutional demand signals confidence in fundamentals. Retail interest that shows retail sentiment and awareness. Overall multiple total times the issue was subscribed. Okay, so friends, if the retail quota is on the lower side, then it can have an impact on the subscription. Important caveat: high oversubscription doesn't guarantee listing gains. Quality matters more than hype. If the overall market is bullish like we had in 2022, 23 and 24, then a not so good company might also get good listing gains. But if the market is dicey, I mean the way it is behaving right now, a lot of uncertainties hanging over our heads, then even quality stocks might not get a good listing. So first of all, you have to decide what kind of returns are you expecting. Are you really applying to an IPO just for the sake of listing gains, or are you applying because you believe that the company has growth potential in the long run, and this is your opportunity to buy shares at a cheaper price? So be absolutely clear about this part, and then you can proceed further, friends. Okay, so sometimes heavily subscribed IPOs list flat or even below issue price if priced aggressively. Yep. So tip for you, friends, pay special attention to QIB subscription numbers. Sophisticated institutional investors, they are going to conduct thorough due diligence. So their participation often indicates genuine value and solid fundamentals. So this is very easy to understand, friends. Nowadays, even before buying a watch or a shoe online, we end up checking the prices on 10 different websites. Now, a QIB, an institutional buyer, is going to invest a huge amount. That amount would be going into crores. So imagine what kind of due diligence they would be doing. So if the QIB subscription numbers are high, that's a sign that this company is a good quality stock. Okay, it's one of the signs, not the only factor, but it is one of the signs. We have the common investor mistakes. You need to learn from others' errors to protect your capital and make informed decisions. Don't blindly apply for any IPO that you come across. Avoid ignoring valuation. Avoid following hype. Try to don't make decisions based on social media buzz, influencer tips. That's the worst trap nowadays. Do your own fact finding, and all market related investments are subject to market risk. They are never going to give you guaranteed gains. Okay, the word guarantee simply does not exist in stock investing. So make sure you don't fall for or false promises. Last is skipping due diligence, not reading the DRHP financial statements or understanding the business model. So do keep this in mind, friends, that IPOs are investments, they are not lotteries. Treat each offering as a long-term business opportunity. Conduct thorough research, understand the risks, and invest only what aligns with your financial goals and risk tolerance. All right. So, if you have any questions, I would be glad to answer them. Any queries for me? Yep. Do we have any queries?
So there is one question. What should I
Yeah.
look for in the company's document before applying?
Right. So, what should be looked at? Like I'll take you to a website. Okay, let us say we want to, let us say Tata Capital IPO. Okay, so there are like several websites that you can refer to. Money Control will also offer you the same data. Now, first of all, you want to understand the size of the IPO. Okay, uh, is wait is my screen visible?
No, sir.
Okay, just a second. Right. So now I am sharing you this app. I hope it's visible. We've opened randomly the first site that came. We searched Tata Capital IPO, the first site that opened. We are checking it out. And so the size. This is a big IPO, 15,500 crores. And now I want to understand what kind of an IPO is it? Is it a fresh issue or is it an OFS, friends? OFS stands for offer for sale. Okay, so fresh issue is worth 6,846 crores. Okay, so this is the money which will go to the company when the issue gets listed. This is the fund amount raised which is going to the company, 6,846 crores, whereas 8,666 crores is offer for sale, which means that these are shares that are going to be sold by people who had these shares before the IPO came out. They could be the promoter family, promoter group, they could be angel investors who invested in this company when it was a startup. Okay, but important thing for me over here is that out of 15,500, only 6,800 crores will be going to the company. So more than half the amount is being taken out by the previous shareholders. So here we have the IPO related details, friends. So this is good. All the numbers are provided in a table format. You have the date, you have the face value, the range 310 to 326. So generally, so yes, it's a 5% price band. Okay, price band will always be in a range of 5%. So from 310 to 326 is exactly 5%. And lot size is there. Now we must understand this part, the IPO reservation. Okay, friends, the reservation. So we can see the retail shares offered. Retail shares offered is 34.91%. Don't bother going into the quantity. Okay, that this will always be a huge number. It will go into lakhs and crores of shares. So we never waste time reading how many shares and all that. Just read the percentage terms. It is 35%. So this is a clear indication for me that this is a profitable company. There is no doubt about it, that it is a throughout profitable company. Okay, then we get to know about the promoter holding. So initially, the promoter before the IPO, promoter had 95.6% holding. After the company gets listed, promoters holding would be 85.5%. So they are basically diluting their stake in the company, right? And here you have your investor category limits, reservations. So if we are in the retail category, then we are applying up to 2 lakhs. Then other categories are also mentioned. Okay, and then about the company related, what does this company do? So generally, if it's a Tata Group company, it's well known. It's easy to verify their data as well. You can just search online that what does Tata Capital do, and you will get all these offerings that they provide various kind of financial services, loans, and here is the result. So, like I said, it's a throughout profitable company. You see, all numbers are positive. There is nothing in brackets. If it is mentioned, the PAT, profit after tax, PAT is mentioned in brackets, it's a sign that that's a negative number. It's in loss. But here everything is positive, so that's great. And here you have your basic indicators, key performance indicators. So return on equity 12.6, that's decent, I would say. Then you have debt to equity, all these. So, but we have to really understand that which are the key performance indicators for this particular sector. We cannot generalize it, friends. Okay, you cannot say that price to book value is 4.10, so it's expensive. We cannot say that. Ideally, you want your price to book value to be between 1 and 4. So if it is slightly above 4, it doesn't mean that it is expensive or overpriced. Or return on equity is 12.6. That doesn't mean that it is bad. Okay, because we have to compare it with its peers, who are its rivals. Compare it with those and see how are they performing. Many a times it happens that unlisted players have actually been doing well, better than the listed players, and that unlisted company is now just getting listed for value unlocking. Okay, so this is again the last thing that I would like to check: objects of the issue. So augmentation of the company's tier 1 capital base to meet the company's future requirement, including onward lending. So they've raised this money to basically increase their purse size so that they can lend more money. That is my simple understanding of the DRHP. Right, we can squeeze in another IPO. Let me show you a slightly older one, but a loss making one, friends. Okay, let's say we take a look at Zomato one. So just to explain the difference. Now, again, this was a combination of fresh issue as well as OFS. Total size was 9,375 crores. And then if we scroll down, so I'm quickly coming to the main points. You see over here, friends, the retail shares offered, that is less than 10%. Okay, so this is a clear sign that this is not a throughout profit making company. At least one of the 3 years before getting listed, this company has posted a loss. Let us find out in the company financials. You see the PAT, profit after tax.
Correct. So sorry to interrupt. We are still in the Tata Capital sheet.
Oh, okay. Sorry. Yeah, so I'm new to this
Yeah, no
stream.
problem.
Yes. Right. So, friends, here we are on the Zomato page. Right. I hope now you can see Zomato.
Yes, sir.
By the way, now its name has been changed to Eternal. It's just that we are looking at past data, so we are still reading the name Zomato. So this was a book building issue of 9375 crores, 9375 crores. The you can see it's a combination of fresh issue as well as OFS. OFS portion is quite small. Now we straight away move to the issue price band, which was 72 to 76, and the face value is 1, which means it's already undergone a split. Even before getting listed, it's already undergone a stock split. And here, friends, retail shares offered, you can say that it is less than 10%. So this is not a profit making company, or rather at that point of time it was not making profits. So scrolling down further, company financials, we can see the profit after tax. It is all in brackets. Okay. So it was posting losses, and these are not small numbers. These numbers are in crores. So 2019 it posted 10,000 crore loss. In 2020 it posted 23,800 crore loss, and 21 as well it posted 8,000 crore loss. Now, objects of the issue: funding organic and inorganic growth initiatives, and general corporate purposes. So we'll have to read more into that. General corporate purposes is not bringing a lot of clarity. Are they really going to use that money to pay salary to the staff members? What does general corporate purpose actually mean? Is it to meet day-to-day expenses? And these are not good signs. Okay, so based on this data which was available with us in 2021, we had decided that this is an IPO we should be skipping. That definitely this stock would be available at a lower price, at a price below its listing. And it did happen, price did go down till 41 odd levels. And from there it turned around. No denying that. But as far as IPO is concerned, it was an avoidable stock. Right, friends? So this was our take on a loss-making company as well. So if you have any questions for me, please post them.
So there is one question from Tarun. What happens if nobody buys an IPO?
Yeah, so that can also happen, friends, that the IPO is not even subscribed one time. Okay, no, so then normally we get to see that companies oversubscribe X number of times, Y number of times. But there may be a case that the subscription does not even complete once. So the company can withdraw the IPO as well. Okay, or even if the subscription is there, but overall sentiment has turned bearish, even in that case, the company can withdraw the IPO. So to give you an example, LIC of India, the India's biggest insurance company, when it was making plans to get listed, their initial issue that they came up with, they had withdrawn it because the response was not as per the company's expectations. Okay, the initial price that they came up with was too high. Market ended up rejecting it. So they started the IPO, but then they withdrew it midway, and then they came up with a much lower price. So that's what can happen, Tarun.
So there is one more question. How can I know if the IPO price is too high or reasonable?
Yeah, so by checking the valuation, that's what you have to compare. Okay, you have to let's visit a website, friends, Screener. Okay, so Tata Capital. Yes, just give me a second. Now you should be able to see my Tata Capital page on Screener. Okay, so I am just scrolling down and looking at the peer section, peer comparison. So this is where we can compare the performance with other companies of the same group. The Tata Capital is also an NBFC. So is Bajaj Finance. So is Cholamandalam, Muthoot, Shriram Finance. Right. So in comparison to these stocks, how is Tata Capital doing? So always watch out for this as well. Okay. I mean, if you try to compare Tata Capital with Bajaj Finance, it would be an unfair comparison because market cap wise, Bajaj Finance is much bigger. It's almost 4.5 times that size of Tata Capital. So fair comparison would be with Chola Investment. Okay, their market caps are identical. So you compare it with Chola and you see the ratios that matter in this sector. Look at the price to book value, look at the return on capital employed. Is it good? As far as this is concerned, the return on capital employed, friends, higher the better. Simple as that. Okay, so if I had to compare the stocks of Tata Capital and Cholamandalam, I would say by the reading that we get over here, ROC wise, Chola is slightly better than Tata Capital. Price to earnings is a widely misinterpreted indicator, friends. In this case, price to earnings, ideally it is lower the better. So even in that comparison front, Chola is having the upper hand, and return on capital employed wise as well, Chola is having the upper hand. So if given the choice between the two, Chola is the better stock, but Tata is not bad. So if two IPOs had come out simultaneously, then I would have gone for Cholamandalam. Otherwise, Tata Capital is also quite decent. Yep. Any more queries? Okay.
There is one more, sir.
Yes. Can I lose all my money in an IPO? Now, the answer is no. You will not lose all your money in IPO. Okay. Company's price won't go down to zero. So at some point of time, even if the company has a horrible listing, at some point of time you will realize that it was a wrong decision. So you can book your loss and exit. So your capital does not become zero. Yes, you can make substantial losses like let's say 10%, 20% loss, but it will not become zero. Right, friends. So this completes my take on IPOs. I hope you all found it knowledgeable and got to learn something new with regards to this topic.
Thank you so much, Mr. Karan, for sharing your valuable insights with us today. It was a truly informative and engaging session on IPOs. We would love to have more such sessions with you in the future. Thank you, everyone, for joining, and have a great evening ahead.
Bye, friends. Good night and happy Diwali.